So I want to welcome every one of you to today's class. So this is the third class of this set. We completed the class April, May, and this is like the May, June class. Okay. So you're welcome. If today is the first time of joining us in this class, please drop a message for me. Let me welcome you. So in the first class, we introduced ourselves to the financial markets generally. And yesterday, Tuesday, we talked about, we look at the basics of the Forex market. And we also talk about how we can open a brokerage account and manage it. Okay. How you can set up your Greenwave exchange account and fund and all that. So if you have more questions regarding that, please talk to your account officer. It's going to be of help, or drop a message for me. I'm going to give you my email at the end of the class. But let me just drop my email. So in case you have any question or any requests, okay, so that's my email. You can drop a message for me. Okay. So let's look at what we have today. We've covered, we've really done quite well. So we looked at how currencies are traded and all that. Forex market participants. We looked at major, cross, pairs, bid, ask, and spread. Those terminologies, swap. Looked at currency codes, rates, and so this is what we want to talk about today, lot size. Okay, this is what we want to talk about today, lot size. But before we go in here proper, I want to show you how to download the trading platform. Okay, so somebody drop a message from, okay, balance and noted. All right. So I want to take us quickly through how we can download. I mean, let's just look at the trading platform. Okay, like we said, that you are going to need a trading platform that will connect you to the market. Okay, it's on this trading platform that you're going to be doing your business. You're going to be doing your buying and selling of currencies and other financial instruments. Okay, so we're going to spend more time on these platforms. What I want to do now is just to show you how to download, how to launch, how to log in into it. And of course, later we're going to look at how you can, the proper way of using it. Okay, so I'm going to greenwaveexchange.com now. Okay, I hope we can all see. I'm browsing now. I'm on my browser now. Please, if you can see, if that's not what you're seeing, please let me know. So greenwavex.com is the website. So I'm going to log in. I've already registered. I told you guys, I showed you guys how to register, just like every other website. You have that. So I will click on login and log into these accounts. And so I told us yesterday that Greenwave Exchange offers two major trading platforms. So the first one is the very popular, in fact, the most popular trading platform known to traders all around the world, which is MetaTrader 4. And then we have the web platform, which is actually more sophisticated. Okay, it's our own in-house web platform. Okay, so every time you want to open an account or you want to add an account, you will have to choose whether you want to trade an account, that account on the MetaTrader 4 or on the web platform. Okay, so let's assume you want to trade on the MetaTrader 4. So once you click add an account and you choose MetaTrader 4, you put your password there, and then you click add. So that's how you do that. Then the next thing you're going to do is to click login. It will ask you to download MetaTrader 4. All right. So you say, in order to start trading from your MetaTrader 4 account, you must download and install MetaTrader 4 for your operating system from the following link. So you click on this link, and then it's going to get you. You can see I'm already getting it downloaded here. Yeah. Okay. So it's already here for me. But since I already have it, I don't need to launch it again. If you need to launch it, you just look for wherever it is in your folder, double click it, and run it like every other software. All right. And so that's a new account here now. All right. If you already set up the account, like if the account is already set up, okay, instead of you to click add account and all that, just click on login. Okay, and it's going to give you the same thing like this. Okay, let's say your own account is just one. You don't need to open many other accounts. You can just use that one. So if it's a MetaTrader 4 account, click on login. If it's not, and you want to use a web if you want to use it, if what you want to use is the web platform, that means you need to add another account. Okay, and use your web platform. Okay, so it's as simple as that. It's as simple as that. Okay, so what I'm going to do next is to show you guys how to log in to your account. Okay, assuming that you are done with everything, you're done with you'll be able to run the software and all that. And so the next thing you want to do, okay, is to launch the platform MetaTrader 4 and log in with your details. So I'm going to share, I'm going to give you a new link now. All right. Sorry, I'm going to, let me show you my MetaTrader 4. Okay. It's not this one. Okay, it's the ear. Okay, so this is the MetaTrader 4 now. All right, you can see green wave and all that. I can see all the different accounts. So for you to log in into an account, all you need to do is to come here. If you are not yet, if you just launch your MetaTrader 4, what you are going to see is red. This is the signal sign to show you whether you are connected to the market or not. You are not connected to the market and you want to connect your account to the market. All you need to do is to come here. I hope you cannot see my this is my cursor. So just click here. You will then click, once you click at this, login will pop up. Then you click login and then you put your login detail. Okay. Don't forget, your MetaTrader 4 is going to give you, when you log in, when you open your account on the platform. Let me go there again. Okay, yeah. Okay, so you can see this login number here. All right, you're going to have this login number. It's only when you have a web platform that you can log in with your email address. But if it's MetaTrader 4, it's the number you're going to use. You copy that number. All right. And then you now go to your MetaTrader 4 and log in with that number. All right. So you go there right here, paste it here, and then you put your password, the same password that you used to log in to your account. And then you choose your server. Okay, whether it's a real account, a demo, and all that. So it's Greenwave Real, and then you log in. If it's demo, click on demo, you log in. All right. And then you can click on save account information so that when next you launch your MetaTrader 4, you don't need to log into your account again, because you don't really have to if it's your system. But if it's not your system, you don't have to save it. All right. Okay, you don't have to save it. So that means next time you want to log in, you will have to next time you launch that platform on the MT4 on that laptop or on that system, you are going to need to log in again. All right, with your details. Okay. So that is it. Once you log into your account, now you are good to go. The first thing you are going to see here is what we call the market watch. And you can see that it's movable like this. Market watch is where you have all the instruments you can trade on Greenwave Exchange with their bid price and their ask price and their spread. Okay. So you want to search for any instrument like Euro US dollar, you can just type it, Euro USD, and click on show. Or let me click on this one. Let me log into another account. Okay, another thing I need to tell you here under your account stuff here is you can have as many accounts as you want. And then you can log in from one to the other. You can see there are 1, 2, 3, 4 accounts here under this server. There's another 1, 2 accounts under this server. All right. So let me log into this account. So you just double click it. It will give the information because I've saved it. I don't need to enter those information. I just click on login. And then you can see you're going to switch. That one is $5,000 plus. The other one is $100,000 plus. So that's how you can navigate from one account to the other. All right. So these are all the instruments that you can trade on this platform, cryptocurrencies to Forex, to stocks, to commodities, all of them are here. Okay, so that's what we call the market watch. Okay, that's the market watch. We're going to talk about all that later. Okay, and so this is what we call the navigator, where you have your accounts and the indicators and all of them. We're going to talk about all of these ones later. And this is your signal to show the connection status, to show that you are connected to the server. And here is where you have the different bars that are for different things. Okay, this place is where you have your chart window. If there is a particular market you want to see, you can just bring it here. Let's say I want to check Bitcoin. I'll just click on Bitcoin, right click on it and click on chart window. And then I'm going to have Bitcoin chart showed here. Okay, so I can now do my analysis on Bitcoin. And if I want to trade, this way I go to new order. We're going to talk about all of these things later. So that's how the MetaTrader 4 looks like in a nutshell. Okay. As time goes, if we still have another class, maybe a whole day, what we're going to do for that day is the platform, the two platforms. Okay, so let's quickly go to the other one. The other one is a web based platform. This one, you can download the software, MetaTrader 4. You can download the software. And so let's come back here. Now let's look at the accounts that I have on the web platform. And so once you have the account, the only thing you need to do to log into that account is here. Just click on login here. If you have not logged in, if you have not logged in before, it will ask you to put in your the email address. Okay. So it's coming up now. And one thing I also advise is that I advise you to make use of Google Chrome for the web platform, because sometimes it doesn't give the full feature, okay, when you use it on Firefox or on other browsers. So it's important that you use Google Chrome. So almost everybody uses Google Chrome. And if you don't use it, you can just download and install it. Okay. So it's coming up now. My internet is not, okay. So let's wait for it. So it's loading the data. So that's a lot of data. So it's trying to load them. So here we are. Here we are. So let me just also take you through this briefly, because this not what we actually want to do today. We're still going to have another day for this. Now, this is where you have this also your market watch, where you have all the different instruments. Now, the good thing about this one is those instruments are categorized instead of just being listed in one place, just like the MetaTrader 4. Okay. And this one is categorized. You have all of them here, all the instruments you can trade on our platform. These are the popular ones. The popular ones that you have, some of them you have asterisk them, you have added them as part of your favorites. And these are the Forex. You can see them there. Commodities, stock indices. We talk about stock indices. That's the basket of stocks. And these are stocks. These are all the stocks: American stocks, European stock, Russian, Arabic. And then we have the cryptocurrencies. Look at all of them here. You can also have your favorites, like any instrument you like, just make it a favorite. Just start it, and then you can always come here to check your favorites. Okay, and you can search for any instrument here. Okay, if you don't want to look for it, you can just use the search button. Okay, so you can see very, very wonderful stuff there. Very, very nice. And then you have your account status, the balance. There's no money in this account. And then you have where you can your chat window here, where you can launch different instruments. Okay, I may just decide to collapse this one. It's all right, cool. So me also, so that I want to make this a little bit big. We're still going to come to this anyway. So this is where we trade. Okay, it's different from my MetaTrader 4 that you click on market order. It's already here. So we're going to talk about the different orders later. So this is how the market looks like. So I've shown you, I've introduced you to the trading platform now. So as even like I said earlier, we're going to have a day where we're going to deal with all of those things. But before that time, in the course of the other things we're going to be discussing, I might just come around there and branch here. Okay, I'm just come around the platform and just show you what I'm talking about for better understanding. So it's good I introduce you to it before I before I do that later. Okay, so don't get it don't get yourself worked up. These are things that we're going to discuss in detail. All right, so just make sure you attend the class regular and on time. Okay, so let's now go to our slide and let's continue. So today we want to look at some concept, because we're still dealing with the different terminologies, terms, and those important things that you need to know. Okay, the other time, yesterday, we talked about spread, ask price, bid price, how currencies are traded in pairs, and all of those things. So today we want to look at the lot size. Now, if you want to be a trader, there's no way you will not understand the lot size. So let me just give us an illustration of what the lot size is. So let's say, for every market you go to, there is a way they measure the quantity of commodities. So if you want to go and buy a book, if you go to the bookshop, you can either ask for one book, or maybe a carton of the books, all those kind of things. So that's the way they measure their own there. Now, a very good example I like using is the rice commodity market. So you go to the rice market. Let me ask you guys, what do you guys know as the standard measurement, okay, for the rice market? I'm asking us now. When you go to the rice market, what's the standard measurement? What's like the standard? Like the standard that the rice people, we want to, I don't know if I should. Somebody said Congo. Do we really think Congo is the standard? Okay. Somebody say derica. Somebody say kilogram. Somebody say bag. Yes, I agree with bag. The standard is bag. Everybody that buys, right, they buy it in bag. Don't you know that? It is when they buy it in bag that they will now bring it down and start selling it, use other smaller measurement to sell it. Do you guys agree? Okay. I'm not really a market person. So if that's not the truth, please let me know. Do you guys agree? So when they want to buy rice, the standard measurement is one bag, a bag, which is 50 kilogram. Okay. After some time, when it's discovered it's not everybody that wants to buy 50 kilogram, they started making 25 kilogram or 25 kilogram half bag. Later, maybe for some students, they start making those ones that are all those big boys in school. Not somebody like me when I was in school. I can't even buy one bag. How will I buy one bag? Okay, so um they started making 10 bag. I mean 10 kilogram, sorry, 10 kilogram. Then I think we have 5 kilogram or so. And then in the market, those women in the market, what did they do? They bought the rice, they removed the bag, they removed it from the sack and started selling it in rubber, the yellow rubber, in Derica, in Congo, in tin, like they make tin, all those different measurements, breaking it down so that everybody that goes to the market will be able to buy. Now they have the smallest measurement, right? What's like the smallest? What do you think? What do you guys think? We are from different places. I have SCN here who is from Akwa Ibom State. We have a lot of people here who are in Lagos or here or there around the western part of Nigeria. We have different people from different places. Maybe even some people from the northern parts, or maybe the eastern parts of people from Port Harcourt. Okay, so when you go to the market, they all have different. There's always the minimum, the smallest. If you want to buy rice, that's the smallest you want to buy. Okay, that's the smallest. I know for the West, the smallest is tin cup. That thing that picnic, that's the smallest. And then I think in Port Harcourt, because I also lived in Port Harcourt. In Port Harcourt, I don't think they don't use tin. I don't think so. They use more of the Rika. Yeah, I don't know if somebody can confirm that protocol, maybe SN and can confirm that for me. Okay, it's a cup. Okay, is it the 10 cup or the Derica cup? So you can see all those different measurements. Those things are ways of measurement in the market. It's just like that. See, it's like the Forex market. I don't know who copied who. Maybe the rice sellers are the one that copy from the Forex market, or the Forex market, they copy from the rice market because they use exactly the same model. Yeah, the same model, but it's just that this one, it's not something physical. You won't see the thing and all that, but it's just like the same thing, the same model. All right. So lot now is the measure of the quantity of the financial instrument or asset you want to transact. All right. So it's very important when you go to the marketplace, you want to buy or sell, let's say, euro US dollar. The broker will ask you how much of it do you want to trade. Very important. So in the Forex market, the standard measurement is what we call one lot, LOT. One lot, just like you have one bag. Just look at one bag and one lot. One bag and one lot. Okay, so one lot is like for the big boys, the guys that have big money to trade with. Okay, because initially, before the brokers started, before we now have so many brokers and all that, it used to be one lot, the minimum. Just like before, it used to be one bag of rice. Okay, so, but because a lot of people cannot afford it and the competition among the online brokers, now they now needed to bring everything down so that people can buy in fractions or sell in fraction, trade in fractions of it. Okay, so one lot is just a name. It's a name that represents 100,000 units. Okay, it's a name that represents 100,000 units. Now that one is possible to know in the Forex, but it's not possible to know how many grain of rice is in one bag. Do we have anybody who knows how many grains of rice is in one bag? Please, if you know, let us know. If you know the number of grains of rice that you have in a bag of rice, okay, it's not possible. But here, you know that one lot, one standard lot is 100,000 units of that instrument you want to trade, or of that currency pair that you want to trade. But just like we have, let's look at it from the big side in terms of sizing. Because somebody's SN says 16.6 million grains of rice. Oh God, how did it get? How did it get to that? Okay, let me focus. So one standard lot. All right, I have to close this message. box so that I will not be laughing. Sorry, guys. Okay, let me just focus on the slide. Okay, so one standard lot is 100,000 units. And just like, let's start from the big side. Now, because we say one standard lot does not mean that that's the maximum you can buy or sell. Just like it's not the maximum you can, the maximum quantity of rice you can buy is not one bag. You can buy 2 bags, 3 bags, 1.5 bags, 2.5 bags, 50 bags, 100 bags, one trailer that can contain like maybe, I don't know, numbers of bags. It's the same thing here. So you can trade one lot, 2 lot, 3 lot, 3.5 lot, 4.5 lot, and all those multiples. Okay. But those ones are for people who have big money. As you are going to see later on when we look at when we break it down and look at the implication of those numbers. Okay. Now the brokers have now broken down these things so that if you can't afford up to one lot, you can buy mini lots or micro lot categories. For mini lot, those ones are lot, those are less than one standard lot. So precisely from 0.1 lot to 0.99 lot. Okay, if I'm not mistaken, from 0.1 lot to 0.99 lot. So less than one lot, right? So which means that if you want to buy 0.1 lot, that means 10,000 units. Do you agree? Do you understand how we came about? That's just a calculation there. Since one lot is 100,000 and you can't buy 100,000 or one lot, then you want to do 0.1 lot, that's 10,000 units. 0.75 lots is also a mini lot, 75,000 units. 0.6 lot, 60,000, and so on and so forth. Okay, those ones are mini lots. And they will now also have the micro lots for those who even want to trade less, want to transact less. So micro lot is less than 0.1 lot. So those ones between 0.01 lot to 0.09 lot. Okay, so 0.01 lot is 1,000 units, all right, and 0.05 lot is 5,000 units. So that is how all of these things, those things come about. So the smallest you can trade is 0.01 lot. Just like the smallest rice you can buy is one tin, one milk tin. So you can see now that I don't know who do you think copied from the other person. I don't know. It's is it the forex market that copy from the rice sellers, or the rice sellers are those that copy from the forex market? Okay, because you can see they use exactly the same model. Okay, so let's go in deeper. We're trying to build up something. So very soon now, you are going to see the implication of all these numbers, what they actually mean, because some of you are seeing units and lot and all that. What we want to see is dollars, right? We want to see dollar. Everybody wants to say, okay, you are telling us stories. What is the meaning of all these things in dollar? Some even convert it to naira or CD or whatever local currency that they use. Okay, so let's go on. Let's see what we have next. Okay, so we are done. That's it about lot size. So what we want to make, we're going to be making use of the lot size, what we just checked in the last slide. We're going to make use of it here. We're going to use it for these two concepts, margin and leverage. Now, when you see a lot of, so many forex that are out there, some of them don't understand margin and leverage. And for traders who are just beginning, sometimes it can be very, very costly. Okay, because they can make mistakes that they will have been able to avoid if they had had the understanding of what marginal leverage is. Okay, so personally, I believe that if you are going into a business, you need to understand everything into every detail, right? I don't know if a lot of people, they want to just make money. We just want to know how we're going to make money and all that. No, don't be like that. Understand every basic thing. Understand how the calculations are being done. Okay, although you don't need to know the calculations before you trade. Okay, I'm mentioning calculations now. I hope I'm not scaring people. Okay, it's not really calculation, it's just multiplications and addition. Let me just put it like that, because once you say calculation now. People say, ah, it's mathematics. No, I'm running out. Don't want to write. I don't want to disturb myself with mathematics again. Okay, just are basic things. Okay, so let's look at margin and leverage, these two concepts. Now, to open a position in the Forex market, a trader can deposit just a small fraction of the required capital commitment. The rest of the money can be lent to the trader by his broker. You know, we talked about leverage yesterday. I said you can trade with the broker's borrowed money. We built a case, okay, of two people who had an idea of a business that can yield 100%. One made use of leverage, borrowed money, and one did not make use of leverage. And we looked at how the leverage for the other guy increased the ROI from 100% to over 1,000%. That's what leverage can do. Okay, so the same thing applies there for those for the Forex market. And the Forex market is highly leveraged, which means that you can be borrowed, or you can be borrowed. The larger, very, very much larger part of the transaction cost. Okay, so the borrowed money now, let's say the cost of the transaction is $50, for example. That's just an example. And you are required to drop just $5. Okay, the $45 that is being given to you is the leverage. I hope you understand that. Is the leverage. You are trying to use that leverage to jack up your profit potential. Okay, so instead of you to trade to make profit on your $5, you're now making profit on $40. So that means they're giving you $45. Meanwhile, you cannot lose the broker's $45. Okay, so that's how it goes. You can't lose that borrowed money. You cannot lose the leverage. You can only lose your money. Okay, but you can use the leverage to make money. So that's it. It's fair. All right. Nobody is going to give you his money to blow it, to use it the way you like. Okay, so the borrowed money is called leverage, while the commitment fund, okay, that means the money you need to commit, like kind of collateral that you need to commit to that trade, is called margin. Okay, leverage is offered in ratio or in percentage. So Green Wave Exchange offers up to 1 to 500 leverage. You're going to see the implication of that leverage now. Okay, so let me take you away from the slide, and let's look at a clean stuff like this. Now, anytime you want to place a trade, there is a need for you to have a margin. Okay, margin is like the cost of that trade. So you can have a leveraged margin or a non-leveraged margin. Let's look at a non-leveraged margin first. Let's say you are not using any leverage. The margin required to open a trade is equal to the units of the transaction that you are buying or selling multiplied by the exchange rate. Okay, it's just like when we want to buy 5 books. The cost of 5 books is going to be 5, which is the unit, number of books, multiplied by the cost of 1 book, right? If the 1 book is 20 naira or $20, that's $100 for 5 books. Same thing here. It's the same thing we are just doing, right? It's the same thing. So nothing different at all. So the margin required for you to take a trade is equal to the unit of that trade you want to multiply by the rate. Let's say where the instrument you want to trade is euro US dollar, and you want to buy 1 lot of euro US dollar. You want to buy or sell. It can be buy, it can be sell. 1 lot of euro US dollar. The margin, the normal original margin, non-leveraged margin, how much you would need for that transaction without a leverage is this: unit, which is 1 lot, multiplied by the exchange rate, let's say the exchange rate is 1 point, um, um, currently it's, let's use the one I use in the example, $1.1715. All right. That is the exchange rate. Let me put it better for you guys. So that's one lot multiplied by 1.1715 dollars. That is the money. But you know, lot is in units. So lot means 100,000 units. So we're not going to use one. We're going to use 100,000. That's the meaning of lot. Okay, lot is just like a bundle of units. Okay, because one unit is actually very, very tiny. So it has to be in bundle, which is one lot. So multiply by 1.1715. So that is going to be equal to what? Let me check my calculator. And so 100,000 multiplied by 1.1715. So that is going to be $117,150. Now look at that. That is, if you want to trade euro US dollar, that is how much you will need without leverage. All right, without leverage. But of course, you can buy smaller units. It doesn't have to be one lot. It can be maybe the smallest one, which is 0.01 lot. If you are doing 0.01 lot, which is the smallest, that is going to be 1,000 times this. And that's going to be like I think, let me check my calculator again. Times 1.17. Okay, so that's going to be 1,171.5. So if you are doing 0.01 lot, that is micro lot. That's the smallest. That's the smallest. So that means even if you want to be trading the smallest lot sizes because of this cost, your account still have to be big because you can't risk the whole of your money or your capital on a trade, right? You can't do that because one trade, the cost of one trade is this. Now, this is why brokers now borrow you money. So let's say you choose let's say you choose a particular leverage. Your broker is going to ask you, what leverage do you want to choose? Okay. You can choose your leverage, the leverage you want to use to trade. Okay. So let's say you are now using 1 to 200 leverage. That 200 is going to be used to divide this. Can you see that? It's going to be used to divide this. So that the guy that is trading 0.01 lot, we only need how much? Guess. 5.8. We need less than $6 to control a transaction that is this big. And this other guy, that one is going to need, I think 117,150 divided by 200. Okay, that one is going to need 585. Yeah. Okay. To control a transaction that is this big. Now, this is now going to be the margin for that trade. So the broker is now saying that, okay, we'll allow you to take this trade, but you will have to drop a collateral. So that means your broker is now going to temporarily freeze this money from your account until you are done with that trade. All right. Now they will now giving you access to trade this amount of money. And trust me, whatever profit you make is going to be based on this. And it's going to be added to you straight away. It's not going to be based on this. You know, this is like your investment money. All right. But you are being given this. You can imagine the leverage. The leverage is like 107, this minus this. That's the leverage is very huge. It's like you are just trading the broker's money. Now, this is the margin. All right. This is the margin for this one. You are never going to lose more than this your margin. Okay. But if you can make money with this, you can make money. And that's why the Forex market is very lucrative. Okay. Because let's even assume that you make 1%. of the transaction. All right, that's going to be for this one. Let's say this one, that's going to be like 11 or close to $12. By the time the $12 is added to you plus your money that was taken, that's going to be $17. So you risk $5, you are making $12 back. That's why it's possible, okay, for you to make multiples of what you are risking on a trade. It's because of this leverage. Okay, if you understand what I'm talking about now, drop yes. If you understand this concept of leverage and margin, drop yes. Now let's now go back to the slide. Okay, we're going to see a cleaner example on the slide. So we're going to look at this example. Mr. Aja opens a live trading account with GWX Exchange, and then he chooses 1 to 200 leverage to trade Euro US dollar. He decides to buy 1.2 lots of Euro US dollar. What will be his margin requirement? And then what will mean margin requirement? We're saying the money the broker is going to temporarily freeze from his account. All right, they're going to temporarily freeze it because that is like the collateral that is paying to take that trade. Okay, because of the big leverage involved. So one standard lock is 100,000 units. So it's just using this formula, just 1.2, you convert it to unit, that's times 100,000, that's this part, then you divide it by the leverage. So that's what we have there. So instead of him to pay as much as $120,000, I'm supposed to pay $120,000 here. Okay. Okay, no. Okay, yeah. So this is how much is supposed to the real money, the real cost of the transaction. Okay, which definitely is, it should be about $120,000. Because of the leverage, this is what he has to drop as margin. All right, $702. So that means his account must be much more bigger than $702. Okay, because let's say his account is $3,000. Once he places this trade, the broker is going to temporarily freeze this money, and then it's going to have like 2,300 and something left from the 3,000 balance that was there to trade with. Although the balance is not going to change, but the equity is going to change. Okay, so that's it. Now, do you guys understand the concept of margin and leverage now? Let me know if you understand it, because I really want you to understand it. So let's look at more examples. Okay. Now, every time you want to open a trade, what the system is going to check is your margin, the margin that you are not used, that you have not used yet. All right. The system is going to allocate margin to every trade that you take based on that calculation that we use, based on that formula. Okay, at every point in time, the system adds up the margin used for all the trades. That's going to be the margin used. Let's say you are on 3 trades open, you're on 4 trades open. The system is going to add the margin together. The system is going to add all the margin together and subtract it from your balance. That will now be your margin unused. Don't worry, I'm going to give us an example. Okay, I know a lot of us, even myself, don't like words and words. We like figures. We like to see the illustration examples. I'm going to show you example. So margin unused is this. So when the trader now wants to open a new position, the system will draw the margin for the new trade from his or his current unused margin, not from his balance. Okay. So the balance is still going to be unchanged until his trades are closed. Okay, so new balance is equal to old balance minus closed. In fact, before I even give us example, let's go to the whiteboard again. So let's do as if we are writing this down. All right. So can we all see my whiteboard? Okay, if you can see my whiteboard, please drop. So when you fund your trading account, let's say Golan fund his trading account with $500, for example. Okay, you say, I want to fund my account with 500. That's going to be your balance. Now your balance is always going to be $500. The only time that your balance is going to change is when you place a trade and close it. So if you place a trade and close it, three things can happen. Is either you are in profit, you are in loss, or the result is zero, or you are break even. So let's say Bola open a trade, and let's say he makes $5. He has closed the trade. His new balance is going to be what? $505, right? Yeah. And if it's a loss also, for example, his new balance is going to be $495. So the balance does not change until you open and close a trade. And if it's zero, it's not going to change, right? Cool. So that's what balance is. So balance is always going to be like that. Meanwhile, when you open trades and close a trade in profit, we call it realized profit. Realized. REALIZED. So that's a realized profit. Okay. $500 is your balance, and you place, let's say, 3 trades in a day, in one particular day. Let's say the first trade you make $10, the second trade you lose, let's say, $7, and the third trade, let's say, you make $12, for example. Now, this one is going to be your realized profit, and this is going to be a realized loss. When you add them, or you now add everything together, for that day, that's going to be 22 minus 7, that's 15. That means for that day, you add $15 realized profit. So that means at the end of the day, the profit is already added here. That's 515. Okay. I'm not saying that the system collate the result at the end of the system will wait for the end of the day before it collates. No, as those trades are being closed, your balance will be changing. Okay, whether it's increasing or decreasing, depending on whether you're having a realized profit or a realized loss. Okay, so that one is settled, right? Okay, so let's now look at what happened when your trade is not yet closed. When your trades are not closed, okay, so let's say SN also fund, let's say it funds $200, this SN's account. And let's say he opened a trade on GBP US dollar. And the trade, as the trade is going on, is going to be changing, okay, because he has not closed it. If the price is going in his favor, the profit is going to be increasing. If the price is going against him, the profit will be decreasing or the loss will be increasing. You know, it will just be moving like that. So he's making profit, but his profit, whether it's profit or loss, is not yet realized because he has not closed it. So that's not called realized profit or realized. It is called floating profit or floating loss, or you can call it unrealized profit or unrealized loss. So that means the results of his trades are still floating because the market is still open. He has not yet closed this trade. Okay. So that's floating. Now, your floating profit or loss does not affect your balance. Does not affect this balance. So let's say the first trade, let's say he has opened 2 trades. All right. And then the first trade is currently at minus $10, and the second trade is currently at plus, okay, don't say plus, so just write it to say, let's say it's $17. Okay, dollars. That is currently, though you'll not be able to really grab it because it's just moving, it's moving. Okay, let's just say at a particular second or microsecond, this is what he's having. At that point, the balance is still going to be the same. It is until he close any of these trades or the 2 of these trades that the balance is going to change. So what is now going to change if the balance doesn't change? That is the equity. Equity is what follows your floating profit and loss. Okay, is that metric or that just like the equivalent of the balance that is following your profit and loss. So when your cumulative trades are giving you profit, your equity is going to be bigger than the balance. But when your cumulative trades are giving you a loss, your equity is going to be less. So the equity is also moving constantly as your floating profit and loss is moving, as your net floating result, your net floating trades, as it's moving, the equity is moving. So the equity is what tracks your floating profit and loss. Okay, so we can say that then that equity is the balance plus the floating, or I can call it net floating. Net is, it will add all the, whether it's one trade or two trades, just put all of them because that's your net floating. If it is negative, it will balance this plus we think to minus. Now, you people did the mathematics in school. Plus times minus is minus, right? We all know that plus times minus is minus. And if it is positive, then this one you add it. If it is negative, then you subtract it. So that's why equity is very, very important when you are trading. Okay, do you get that? So do you understand? Do we have anybody who now understands the difference between equity and balance? Do we know the difference between realized result or realized profit and loss and floating profit and loss? Okay, do you have anyone who understand that? If you have understood this very well, please drop a message for me. Please drop yes. Now I always like seeing your yes. Drop a yes so that we can continue. I want to see yes from like 5, 6, 7, 8 people. Then the others will watch later in the video. You know, we have people who have to watch like 1 or 2 more times before they understand very well. Okay, so I have okay. I'm only getting yes from 3 people. So I'm getting a question from Alexander Obeche. He says, so finally, if a trade is closed, the equity can determine the balance. Now, if the trade is closed, this formula is still going to be maintained. But if the trade is closed, the balance will change. The net floating is still going to be there. The other net floating are still going to be there. The only time when the equity and the balance are equal is when you close all your trades. When you don't have any floating trade. When you don't have any floating trade, that is when your equity will be equal to your balance. Okay, but this is the formula that the equity uses to track the floating result. Okay, the floating traits, the result of the floating traits. So this is the formula. So it's balance plus the net floating. If it's positive, equity is going to be bigger. If it's negative, equity is going to be smaller. All right. Okay, so I'm having a lot of yes, yes, yes. Okay, thank you very much, guys. I appreciate that. I appreciate that. Okay, so let's now go back to, let's go back to our slide. Let's go back to our slide. So if we have to still come back here to the whiteboard, we'll still come back. Okay, so so you can see the equity is balance plus floating profit minus floating losses. Okay, this floating profit, that's like the net floating, right? Okay, that's like the net floating. So your new balance is not going to be your old balance minus or plus whatever you get as your result. Okay, I've already explained all this. These ones are just the words that we've already explained all that. Okay, so let's move on. Okay. Okay, so can we all see my slide? Please confirm that you can see my slide. So we'll look at these examples. Okay. All right. Thank you. So let's look at Mr. This man has $5,000 as his balance, and he opens the following trade with the leverage of 1 to 200. So this is the first trade. Let's say this was the first trade it opened. Let's say on the at a particular time, 0.1 lot of euro US dollar. And this is the margin required. Remember how the margin is being calculated. 0.5 times 100,000, because 0.5 lot is going to be like 50,000 units. Then multiply by the exchange rate, the price, okay? The current price of euro US dollar, the time the price he wants to buy it, okay? The price that he wants to buy, that the broker is giving to him to buy it. So it's going to be multiplied with 50,000, because 0.5 lot means 50,000 units. And then the result of that is $292. So that means he will be able to take the trade because he has $5,000, which is enough to accommodate this margin. So let's say somebody that has $250, will he be able to place this trade? No. Somebody with $290, will he be able to? No, because the margin required for that trade is not enough. So what does it have to do? You just have to lower. If the money you have is not enough, then the person will have to lower the quantity of trades you want to take. Okay, so this is the margin required. This is the margin used. Pardon, this is a mistake. This should be $292. So this is the margin required. So let's say he has placed this trade and he was able to use this $292. That's the margin he has used. He has opened the trade. This is the margin required. This is the margin he used to open that trade. So immediately, he activated that trade. Okay, the system is going to quickly calculate his free margin. Okay, it's going to quickly calculate his free margin. Excuse me. Okay, so so this is the margin used, because this is the margin required, and then this is the margin used. Now the system will now calculate your free margin or margin unused. Okay, your free margin or margin unused, and that's going to be $5,000 minus $292. Okay, this is $4,708. That will now be your margin unused. Even though the trade has not been closed, your balance is still $5,000, but your free margin is $4,708. Okay, so this man has $5,000 and is on 1 to 200 leverage, and he opened the first trade, 0.5 lot of euro dollar. It could be a buy, it could be a sell. The margin required is $292 based on the calculation that we just talked about. And so he said, yes, I'm okay. He was able to go on with the trade. So this is going to be his margin used. His balance is still $5,000 because the trade is still ongoing. He has not closed it. It's until he closed the trade that the balance is going to change. So this is the margin used. Next time you want to open another trade, the system is not going to look at the balance. It's going to look at the free margin that he has that is unused. Okay, it's going to look at the free margin, and the free margin, the new free margin or the free margin is going to be 5,000, which is the balance minus the current floating margin. Okay, because it's a floating margin. Or it's until he closed the trade that the margin will be released. Okay, so now he has 4,708 free margin. Okay, now he's opening another trade. This is the margin required for that trade. This is the margin unused, which means they can open this trade. The system is not going to look at 5,000. It's going to look at this. So this trade has gone through. So the margin is now going to add the margin on the two trades together as 292 plus 344. So you got 636 as the margin used, the combined margin used. So the new free margin is now going to be 5,000 minus the combined margin used. So you have this. The same thing goes for this example, 696 margin required, and this is how much he has as free margin, which means he can still go ahead with this trade. System is going to add the margin required on the 3 trades, and this is the margin used on the 3 trades. So this is going to be the new free margin, and then go on. It's going to go on like that, like that, like that. Okay. So same thing here. This is what he has left. So at any point in time, let's now say the man want to open a trade that is more than 3,000. The system is going to reject. Or let's say that is more than this. The system is going to reject. And the man might be like, well, I have $5,000. What happened? Why can't I open that trade? You can't, because you don't have enough margin for it. So I still, last year a lot of people asking questions and all that. But I have this money, I can't open this trade. Why? So the question is the margin. So always make sure that you manage your margin level, okay, very, very effectively. Very important. And at least you understand when you open a trade and the trade is not going through, despite the fact that you have enough balance. Okay. Now, there are some caveats to this. The first one is that if your trades, let's say 1 or 2 of your trade, or even all of them, if they are in profit, the margin can be released temporarily. Okay. If they're in profit, the margin can be released to your account. If you have made as much money on that trade as the margin, or even you are in profit, once you are in profit, the margin will start reducing, which means the system is going to be freeing up margin for you again to open new trades. But if you are in losses, the margin is still going to be held, all right, while the market continue to calculate the results of your trades. So it's always very important that you don't over leverage your account and you don't do over trading. So you don't open too many trades with big lot sizes that your account cannot withstand, because there are repercussions to it, there are implications. Okay, there are repercussions to that. Okay, because, okay, this is it. If, let me say, I have messages. Let me see what happened. So somebody says, I'm lost. Okay. Alexander said, this means that total margin is safe, even if you lost a trade. There's nothing like, your margin is there. Your margin will be free to you at the end of the trade. Okay. What the broker is just trying to do is to make sure that you don't lose their own money. Okay. So the margin is like the collateral for that trade. So once you are done with your trade, the margin is going to be freed. Or if you are making profit, the margin will be freed, okay, gradually. Okay. So, but we're still going to look at the aspect of where we calculate profit and all that. All right. So that's it. Now, it's very important that you make sure that you manage your margin level, because there are 2 concepts. The only person that can close your trade is yourself or any other person that you give the permission to close it. But that's not all the time. There are some times the broker can force your trade, can forcefully close your trades. Now, the first concept is what we call margin call. When you are exhausting your margin and your margin level has dropped, the broker, it could be about 50% or 100% margin level. Okay. I'm going to show us that next week when we look at the MetaTrader 4 again. Okay. Now, when your margin level, which means like the current, the percentage of the current margin that you have, your free margin, okay, against your overall balance. So when your margin level it has dropped to a certain level, the broker is going to warn you. Okay, the broker will warn you. That's what we call margin call. Just want you, give you notification that your margin is getting so tiny, it's getting red. Okay, so there are 2 things. You could either close some trades, maybe trades are in profit, or trades are in just now. You just can just close some trades to free up some margin, or you fund more. Okay, so we have different types of trader. We have some people who are very, very aggressive. So this one is only for people that are aggressive. People that want to turn $100 to $1,000 in 1 week. This is for them because they are the ones that overuse their margin. If you are not one of them, you don't even need to understand this. Okay, you don't even need to worry about this at all. Okay, no need to worry about margin call. You don't even need to worry about margin and all of that. All you need to just know very well is how to calculate your risk per trade. Okay, but it's very important that we still need to know. Okay, but this one is really, really meant for people that are very, very aggressive. Okay, we have traders who always look for very big leverage so that they can use some kind of aggressiveness to trade. Now, there's nothing bad about being aggressive, but at least you must know what you're doing. Okay, so you have to know what you are doing. You have to know that yes, you are aggressive, and that is what you want because it's your money. If you turn the $100 to $1,000 now, or 1,000 to $1,000,000 now, it's your money. You enjoy it. If you lose it too, it's your money, and then you bear the consequences. All right. So it's very important that you know this. Okay. So margin call is a warning. Now, there's not what we call a stop out. When you get to the stop out level, that means your margin level has fallen to the level whereby it's getting to a certain level where you might start losing the broker's money. Okay. You might start losing, you can't lose more than your balance. That's it. You can't lose more than your balance. So let's look at it. Okay. Let me bring up something. Now, some of you would say that, let's say your balance is $500 the fund, and you open a trade. You open trades. We said that the balance is not going to change. Okay, the balance is not going to change until you close a trade. So somebody might say, "Oh, is that so?" Okay, now let's say you now have 4 trades that are in losing position. You might just say, "No, I won't close them," because if the person is lucky, the price can still turn around and start giving him the profit, and the thing can still turn to profit. Or the person might just leave the losing trades to continue to lose while he's closing the profitable ones. Okay. I don't know if you guys understand what I'm talking about. So he might just let's say he's losing, all the combined losses is about $450. Okay. Meanwhile, there are some profit he's making and he's closing those ones, is increasing this, increasing this. Meanwhile, he's piling up the losses. Okay. That would just be like a very easy money. You just make sure you don't close the trade, right? That would be like the logic. Don't close your trade. Just those ones that are losing, just leave it there. The profitable one, be closing it, and then you withdraw money. The broker will deal with that. So that's not going to happen. Okay. So because the broker is going to manage all your floating profit. Once you're floating, your net floating can never be more than your balance. Okay. If you like, leave all those trades. Once it's getting to that level, the broker is going to stop you out. That's what we call stop out. They're going to forcefully close those trades. All right. They're going to forcefully close. They can close all of the trades if the condition is very critical. But if the condition is not that critical, to protect themselves, they might close some trades. Maybe some of your biggest winners or losers or something like that. Okay, they have criteria that they use, okay, to close those trades. That's what we call stop out. Okay, now stop out and margin call is for traders that are very aggressive. If you are not an aggressive trader, you don't really need to worry so much about those things. Okay, but it's also very important that you understand what they are. All right. So